Hi, Elliot Yu here. Listen, I'm about to do something I've never done before. And if you're an individual investor looking to earn additional income from your portfolio in today's pay nothing interest rate world, if you're just sick and tired of all these third-rate hacks in the mainstream financial media telling you to be content with a pathetic 1.8% yield from the S&P 500, or the paltry 2.08% in the most popular quote-unquote income ETF in the US right now, and that's the Vanguard Dividend Appreciation Fund. Or maybe you're just as fed up as I am about these so-called experts on Wall Street and in the mainstream financial media who advise selling income-paying stocks right now because interest rates are on the rise. All the while, of course, many of these same talking heads are busy peddling low-yielding ETFs and target maturity retirement funds to individual investors, all for the sake of more fees for them and pathetic yields for you. If any of those frustrations sound familiar, then I promise you this presentation today is well worth your time and attention. As I said, I'm going to do something today I've never done before. You see, my colleague Roger Conrad is an award-winning expert when it comes to income investing. In fact, just a few years ago, he was ranked first out of more than 100 investment advisory newsletters in risk-adjusted returns by the Hulbert Financial Digest. And just this past weekend, Roger released an exclusive presentation for readers of our premium deep dive investing service, covering 5 secret high-yield investment opportunities. This material is just pure gold. These investments, overlooked by most on Wall Street, offer yields of 5%, 6%, and even 8% and higher. In fact, the reason these investments offer such high yields is because they're not the mainstream names held in all those pay-nothing income investments most pundits are trying to sell you. Look, it wouldn't be fair to our paying subscribers for me to include all of Roger's presentation and recommendations in this free video. However, I've decided to include a selection of Roger's most recent presentation here on this website, absolutely free of charge. However, I don't want to anger any of our paying deep dive investing members, and I don't want this video to go viral. So I'll be taking this presentation and this entire website down for good tomorrow night. So without any further introduction, here's a selection from my colleague Roger Conrad's latest exclusive income presentation. I urge you to watch it through to the end before I must take it down for good.
Well, hello everyone, and welcome to another episode of Deep Dive Investing. My name's Roger Conrad, and today I'm going to talk to you about fixed income opportunities, and specifically fixed income opportunities on the high yield end of the spectrum. I think that's definitely where the value lies at this point. I'll be explaining why, and I'll be giving you some recommendations to follow, in addition to following up on a deep dive investing we did late last year, actually in November, that introduced a number of these high-yield securities. So that's what we're going to be doing here today, and thank you for joining. I want to first talk just generally about high-yield bonds. This is a graph of the Bloomberg Barclays High-Yield Corporate Index. And so this is a graph of prices of various high-yield bonds. There are actually almost 2,000 members of this index, and it's recalculated or rebalanced every month. So it is pretty true to prices and to capitalization, which in the case of bonds is simply how much was issued of these various bonds times the current price. So over almost 2,000 members. They recalculate it monthly. It's generally medium to low maturity in terms of the number of years when all these bonds will then mature. The average maturity right around 6 years. So the average duration is a measurement of exposure to or sensitivity to interest rate changes, is about 4 years. So that's what you have here is a pretty good representation of high yield bonds, which are bonds that are not rated investment grade. They're bonds rated either below BBB minus by S&P and Fitch, or below Baa3 by Moody's. That's considered to be, again, sub-investment grade or junk. So those are the types of bonds this index holds. It's a fairly large index. It's about almost $1.3 trillion of index. So pretty representative. And as you can see here from the graph, this shows you the white line shows you what's going on with this index. So that rising white line indicates that it's been a pretty good 12 months for high yield bonds in general. They've been going higher as represented by this index. The other three lines, of course, are the 50-day, which is the purple line, the 100-day, which is the green line, and the 200-day moving averages, which is the yellow line. And you can see this index well above those rising lines. So it's a pretty bullish technical picture for high yield bonds. Now, if you take a look at this next slide, you can see that this strong picture for high yield bonds has occurred even amid a weak picture for investment grade securities. So this is a graph. The TNX is a yield graph. So when you see that 29.63 up there in the upper left-hand column as a price, that's basically the 10-year Treasury note yield of 2.963. So a little bit under 3%. And you can see that over the past year, it has risen fairly substantially. Go back to about this time last year, you were about 2.2% on this yield. So while it hasn't risen above 3% and held that level, it has risen pretty substantially. I think this makes a couple of big points here. One is that high yield bonds don't follow in lockstep with benchmark interest rates. And the reason is that there's another element to their prices besides just plain old interest rates. It's the risk premium that investors require to buy bonds that are rated below investment grade, which again, these credit raters rate companies in terms of quality, in terms of kind of setting odds in terms of how that you'll be paid off at the end. And there's always a difference between bonds that are rated below investment grade, a difference in yield between bonds rated below investment grade and bonds rated above investment grade. And the yield varies from time to time, but as the economy gets stronger, when you have times of stronger growth, when you have people more interested in taking on more risk, they're more willing to take on or they're willing to pay higher prices for high yield bonds. So that's stronger economic growth is a factor that pushes up benchmark rates and particularly bond yields for investment grade securities, but it tends to push up prices for sub-investment grade securities. So that's what's been going on. It's been somewhat unusual, I guess. We haven't seen this type of action in quite some time, where high yield securities have managed to rally even as investment grade securities have dropped. But that is the case here, and I think it will continue to be the case going forward. Again, why is that? What are the reasons? This next slide talks a little bit about that. What are the reasons why investment grade bonds have, or why junk bonds or sub-investment grade bonds have rallied even when interest rates are rising? Strong economy, number one reason. Heightens the appetite for risk. Investors require less of a risk premium to buy bonds that are riskier. Simple as that. Defaults and perceived default risks are lower. We've actually seen a drop in defaults. That makes sense because, frankly, even the weaker companies out there can now issue new bonds. They can roll over or refinance their existing bonds, often at better rates. And the result is that we've just seen fewer defaults. And that, of course, has pushed down the perceived risk of default, which is more or less what the accounts for that risk premium. So very, very important factor there. Of course, when we do start seeing more defaults, which will happen when the economy does start to weaken, happens in every cycle. Some companies just get over leveraged. They make the wrong bets, or maybe the revenue doesn't hold up to make those interest payments. So we will see more defaults. Then I think we'll see the opposite trend occur. But right now, that's a big reason why we've seen this rally in high yield bonds in general. The third factor is decidedly technical. Those first two factors are very fundamental, very much related to the business cycle. The third factor is very technical, and that is actually a result of the kind of market action that we've seen recently, the restructuring really of the market, where you've seen exchange-traded funds that are set up to mirror various indexes, be they large, well-known indexes or proprietary indexes. ETFs are extremely popular because they give investors an opportunity to own multiple securities for one buying one fund, and unlike a mutual fund that's actively managed and therefore has expenses, you really don't have that many expenses. The portfolios tend to be pretty stable or rebalanced from time to time, but you don't have to employ a man. They generally don't employ managers, so they've become very, very popular, and in so doing, they become the preferred instrument of for many investors. And in the case of high yield bonds, investors, of course, very wisely thinking that you want to be diversified to minimize the risk of an individual bond going bust. That's a perfectly acceptable and perfectly understandable sentiment there. And ETFs are perceived as being able to offer that. The problem that having so many ETFs out there, and particularly these ETFs that are growing by leaps and bounds. And, I remember when individual stock investors accounted for most of the trading on Wall Street. And that changed when mutual funds overtook them in the mid-'80s. Well, now we've had the ETFs overtaking the open-end mutual funds, changing the dynamic and locking up a lot of the supply for of the high-yield bonds that are available. And it's in a reasonably small market, as I'll explain in just a moment. So that's having a big impact, just simple supply and demand. More demand for yield at the same time. ETFs are locking up the available supply. Very interesting kind of sub-factor here. I think this could also unravel in a very big way on investors in a typical junk bond when the next time we see a reversal, when people don't want to own so many junk bond ETFs, and these ETFs, suddenly dump all the supply on the market. Something to worry about in the future, but right now it's a very positive factor, a technical factor that we haven't seen in previous cycles. Higher benchmark rates are leading to higher yield seeking, so that's also made high yield bonds very popular, and again, people seeking them out in an environment where ETFs have locked up a lot of the supply. And then finally, I think one of the biggest reasons and one of the biggest changes that's happened in this market since I did the deep dive investing last year on high yield bonds and gave you a pretty large selection to buy, is that the energy sector has really rebounded here. It's stopped being a drag on the junk bond market. At the time when we put that report together, there had been a number of energy bond defaults. We were still seeing dividend cuts, which had really soured the mood to own energy stocks, and that, of course, had put pressure on bond prices because when companies such as midstream companies that have big capital expenditures and so forth can't really raise equity on favorable terms, in other words, can't sell stock for a price that makes sense for them and locks in, and enables them to earn a return on their investment, they typically will turn to the debt market. Credit raters know it, bond investors know it, and that puts pressure on those bond prices. So these were definitely big-time trends that had been in effect for a couple of years, really, for energy stocks. But what we've seen this year, and since that report in particular, is that there's a real turnaround that's become evident when companies have announced earnings and have announced guidance. A real turnaround in the balance sheet situation for many energy companies. So energy has stopped being a drag. That's been a huge plus for the high yield bond market because energy stocks were accounting at one time for many of the defaults, at least a good plurality of the defaults that we've seen. Obviously, the reason was that energy prices crashed. We came down from $100 oil or $100 plus oil to really mid-20s per barrel oil in early 2016. Natural gas prices coming down as well. So not hard to see why we would have seen a lot of defaults in energy companies over that time. But probably the biggest surprise, again, for a lot of people has been just how fast the energy sector has repaired itself. Again, this has been a big plus for the high yield bond market. So that's why, again, sort of a short synopsis of why high yield bonds have outperformed investment grade paper. We still haven't seen that 3% being held in the 10-year bond, so we still haven't seen that real kind of blow off or decline in higher rated bonds, but definitely a big backup in yields there. And at the same time, we've seen a big rally in high yield bonds. I think this will continue to some extent. It has given us some nice profits in some of the picks that we've had before, but I think this will continue to some extent. But I do think there's some nuances that we all have to be aware of, and that's really one of the key purposes of this deep dive investing issue for you is just to alert you to some of those. Just a few more slides on the macro picture before we get into some individual selections. Again, I've talked about credit spreads narrowing, and we can see here that they definitely have graphically over the last. This shows you the last 5 years, and it's the difference between the Barclays U.S. Corporate High Yield Index, yield index, the yield of that index versus the 10-year a Treasury note. So you can see quite a spike there in corresponding with the demise of energy companies, and that was back in, again, the early part of 2016. But those spreads have really tightened up here and have remained low, have remained very, even on these averages, have remained very low for an extended period of time. Again, I think they can go lower. It really does depend a lot on economic growth, but this is the environment we're in right now. Obviously, you take a look at that early part of 2016, that spike. That's what happens when the economy starts to slow. So that's what happens to the typical high yield bond. I'm going to talk about some high yield bonds. I don't think that's going to happen to when the economy slows down, but that is a big part of the analysis right now. You can't just throw a dart and expect any high yield bond to do well going forward. That's a really big point that I want to make to you in this presentation. This graphic here shows you U.S. high yield issuance. I made that point earlier about how we've had a restricted supply of high yield bonds. That continues today. We really haven't seen a whole lot of this paper get out there. What we have seen, though, is a number of other structured loans and so forth that high yield companies have been doing. That's partly a response to the fact that it's become very difficult to for many companies to issue high yield debt, particularly some of the weaker credits out there, where we've seen a really prolonged decline. Companies like Frontier Communications that I talked about initially as a value trap. I'm going to talk about it again as a value trap a little later in this presentation. But basically, a lot of these companies, supply has become prices have run up because supply has been restricted. But at the same time, credit risk really hasn't diminished because there are other avenues that riskier companies can borrow. So that's my point here with this slide. A tightening of supply again because, with fewer issues, ETFs really gobbling up the supply, so that's run up prices. But prices have run up at the same time, actual risk has actually increased. So very important part for this market right now. High yield bonds, another point about them is they tend to not be that big in issues. That may sound counterintuitive because obviously companies that have sub-investment grade ratings, junk bond ratings, by definition have weak balance sheets. So their debt is high relative to the size of the company. But when you take a look at all these, all this various float and so forth, aside from there are a few larger cap companies that do have lots of debt attached to them, companies like Sprint, for example. But by and large, these companies that have these sub-investment grade ratings tend to be smaller. So their problem isn't the absolute level of debt that they have. It's the relative level of debt that they have. The level of debt they have relative to their size, relative to their revenue base, and so forth. So this is a graphic courtesy of Bloomberg, such as many of the graphs that I'm showing you today are also courtesy of Bloomberg. A great information service. But this graph is more or less is a graphic of the larger components of that index. You can see that if you look all the way over in that right-hand column where it says weight, you can see even the biggest holdings in this group are not very big in terms of the overall index. So again, because there's so many in this index, almost 2,000 names in this index. But you can see that they're and you can see the market value of these bonds, the vendor price, which is basically percentage of par value. So if you look at that, those bonds there, you see a bond that's listed as 97 as a price. What that is really $970 off the par with a par value of 1,000. So that's a way that and many of the bonds that you're going to see priced here in this report are priced in that same way. So they'll be quoted at, say, 97 or some percentage of par value, which is typically $1,000, and that's how they'll trade. But when you go to buy them, you have to multiply by a factor of 10, because again, we're talking about par value, and when you see bonds quoted, it's always as a percentage of par value. But I think the main point I wanted to make here from this list is that none of these are really that big. And the next slide, I think, brings that into even more graphic relief here. Here, AT&T, of course, one of the larger players out there, as much debt as anybody after acquiring Time Warner. And compare it against various sub-investment grade rated companies, including some of the larger ones there. You can see AT&T's debt is, except for Charter Communications, which is a big cable company with about $71 billion of total debt, AT&T's overall debt dwarfs anything you see here. Of course, AT&T is pretty solidly investment grade. Why is that? Well, it's a much stronger company than anything you see listed here. It generates or is expected to generate about $25 billion in free cash flow this year, and which is extraordinary. That's free cash flow. That's after industry-leading capital expenditures in the telecommunications industry. So even after beating everybody else, and in fact most of its rivals, except for Verizon, it's actually spending 2 to 3 times more every quarter. Big advantage there in terms of being able to deploy technology and so forth. But even after that, it's still generating $25 billion of free cash flow. So that's why it's rated investment grade. Whereas you look at Sprint, which spends a fraction of what AT&T does on its network. They'll be lucky if they do a quarter of what AT&T does this year. They are actually in the red in terms of free cash flow, and have been pretty routinely. So you might ask, well, why are they on Credit Watch Positive? Well, that's because T-Mobile USA, which you can really think about as Deutsche Telekom's unit in the United States. Deutsche Telekom owns almost 2/3 of that company, and it backs it very strongly with a very strong balance sheet, which is very securely investment grade. Well, Deutsche Telekom, through its U.S. unit, T-Mobile USA, is making a bid for Sprint. That's why that balance sheet is on Credit Watch Positive. You take away that deal, I think it's going to be very hard for that company to even stay solvent. Look down the list here. You can see, they kind of vary in terms of what's going on. I would say one company that is very much on the come, and we have recommended it. So if any, or two of the companies here rather that have really done well, and I think are good examples of the kind of company issuers that I like to see are AES Corporation, CenturyLink. AES has actually been upgraded to BB plus since last year when we initially recommended one of its bonds in a deep dive investing report, and they are going to achieve investment grade metrics by next year. very likely we'll see a bump up to investment grade. That's the kind of company that we want to have in term, when we buy companies that are getting stronger, and those are companies that can still narrow the discount between their bonds and and higher grade securities, just because they're getting stronger, and thereby when they narrow that yield gap, they tend to they increase in price. That's sort of the inverse there. You got when yields come down, and in this case when the yield spread comes down, prices go up. So as an investor, you win from capital growth, as well as you're locking away a bond that's yielding considerably more. If you buy before all this happens, that's yielding considerably more than the risk-free rate. So that's a big point from the bonds on this list. But a larger point is just simply supply is limited for these, and it's another reason why we've seen a lot of these bonds run up to levels that really aren't justified by the kind of risk that they're carrying. So again, that's another big point I'm going to be making more as this presentation goes on. Just simply that don't take for granted, just because some of these bonds have gone up, that bond prices have gone up, that the risks have actually diminished. We really want to be extremely careful here with all these securities. And which sort of brings me to this slide, which is value or value trap. You look at something typical, if you're like me, you're an income investor, you take a look and you see the yield and you're interested if it's above a certain level. I've learned from pretty long experience that there's a necessary second step involved there, and that is making sure you know where the money's coming from to pay that yield. So typically, I recommend a lot more stocks than bonds, and I am very interested in what's behind the dividends that are paid on these stocks. I apply the same discipline though to the bonds that I recommend, and particularly the higher yielding bonds that by definition carry more risk. And I want to know exactly what's behind that yield, what's guaranteeing those interest payments. And if I can't see what it is, and I'm not comfortable in what it is, and that it's lasting, and that it can sustain even when this economy does eventually slow down, when the capital markets get harder, then I'm going to stay away. I'm only going to go with the companies that I think are going to give me that value and are going to be able to not just hold whatever they're paying during a downturn, but actually get stronger. And in the case of stocks, continue to raise dividends. In the case of bonds, get stronger on the credit basis, narrow those credit spreads. That's really what it's all about right now. Looking in the bond market, you really want to be in the kind of high yield bonds that will have the potential to gain value going forward as their underlying companies get stronger. You want to avoid the typical high yield bond, which has been run up on some of this excitement about the economy, that's run up on this technical factor that I described about ETFs. You want to avoid those types of things. Value is here. Credit rating hasn't kept up with company recovery. One of the things I've really noticed, particularly following the utility sector over so many years, in various advisories and so forth, is just how far behind credit raters often are to the prevailing trend. It took companies a long time to downgrade. It took the credit raters a long time to downgrade companies when the collapse of Enron occurred, for example. It took them even longer, though, to recognize that companies didn't, that the industry was able to repair itself, and when it did repair itself. And so as a result, we've seen credit ratings really lag in the electric industry behind where they should be if you just look at the metrics. That's a big positive when it comes to buying bonds, because it gives you opportunity to get into companies that are getting stronger. The credit raters aren't going to, they're terrified of making a mistake, so they're not going to raise those credit ratings until everything is in place. And that tends to be, pretty far after the trend is well in place for recovery. So we have a lot of opportunity to buy low in something that is invariably heading to that higher place, as AES is, like I talked about. So definitely looking for companies where the credit rating hasn't kept up with the company recovery. There are not as many in the electric space as there were 5 years ago, 5 years ago, for example, but there are many in the various essential services businesses. And again, this is pretty much one of the surest ways to make money in any market, particularly the bond market, which and where you see the benchmark, where it's very hard to make serious money in this day and age with benchmark yields as low as they are. Guilt by association with the soft sector. Communications is definitely one in that category. But I think also the way that people view emerging markets is sort of this amorphous, blob out there where everything moves together. That's given us another opportunity here, and I have a pick for you a little later to take advantage of that. Another place where value would be where management has a silver bullet to begin producing free cash flow after dividends, and that is simply cut those dividends. There are plenty of companies out there where you have dividends or distributions that are not sustainable. They're borrowing. There's pressure on their bonds. There's pressure on their credit ratings as well, and management is taking notice. And when they do take steps, again, even if it becomes pretty obvious that they're going to, credit raters won't react until they actually take the steps. They're very much afraid of getting it wrong, so they don't move very quickly. And so as a result, you can frequently buy bonds of companies where a dividend cut is coming in order to right the cash flow balance and get them at low prices and then enjoy some pretty nice rebound there. So that's another place value is in this market. Values are not where underlying businesses haven't bottomed. So you might see a bond out there with a huge yield. You might be tempted. You might say, well, they're not going to declare bankruptcy, are they? But you're not going to make any money until that underlying business bottoms, until things actually start to get better. I mean, if your only reason for owning a bond is that things won't be so bad when they file bankruptcy, that's usually a pretty good reason why you probably ought to steer clear. I made that mistake a couple of times in the energy bear market. We looked at some of these master limited partnerships that were producers of oil and gas, and the ones that really stand out are some Lynn Energy bonds. Of course, Lynn eventually did go file bankruptcy. They eventually came out of bankruptcy and have given us a pretty innovative plan where they've split their company that should really generate a lot of shareholder value. So that's worked out fairly well, holding on all that time. The problem is that we had to hold on a very long time to reach that outcome. So generally speaking, if I had to do it over again, I would have avoided those Lynn bonds entirely. So again, I think this is very, very important at this point in time in particular because conditions are pretty good right now. The stock market's going up, the economy's doing well, the capital markets are generally open for business. We have this big rally in junk bonds, partly because the ETFs are just eating them up, and companies aren't issuing them. They're going in for these loans, but so if companies are doing poorly, if their bonds are crashing in that kind of environment, think about what might happen when things really do go south. So it's just not worth it to chase a big yield in the high yield space. You really just want to. This is the game that's best won on the margins, and we'll make most of our money in stocks, but we can do pretty well locking in pretty good returns in bonds if we're not greedy. Again, if the underlying business hasn't bottomed, you don't want to own either the stock or the bond. I extend that. A lot of people say, well, bonds are different from stocks. I don't care if I don't want to, but my rule is if I don't want to own the stock, I don't want to own the bond either. So again, don't be a yield chaser. Daunting debt distribution. Again, it comes back to that same thing. If a company has a lot of debt coming due in in the next couple of years, say, there's quite a bit of risk there. They have really no choice than to go into the market. And if the market should happen the market's pretty good right now, but if the market should happen to worsen, things aren't going to be so good. There were a lot of companies in 2007, 2008 when credit froze that had to go into the market and borrow and simply were unable to do so at rates that would enable them to avoid bankruptcy. Happened with a company called Fairpoint Communications, very steady rural telephone business, particularly at that time, and did a merger. Just did it at the wrong and wasn't able to finance it. They ran into a few regulatory delays in New England, the upper New England states, and as a result, they weren't able to close the deal in time, and they wound up closing it at the worst possible time, issuing bonds that were yielding in the teens, and soon after they declared Chapter 11. So you really want to be careful in terms of debt distribution. That's why I give you that kind of data on the recommendations that I have, and I'll be doing that for the ones that I have for you today. But generally, a bond where the underlying company has staggered its maturities, in other words, has some this year, some 5 years, some 10 years down the road, is generally in a lot better shape to weather economic shocks than one that has a whole lot of debt coming due. So that's a big factor. Again, things are going pretty well right now, but eventually capital markets are going to tighten. They haven't repealed the business cycle, so dawning debt distribution is a big red flag for me. I also want to avoid companies where a single event can undermine the price of these bonds. So, as a company, say, facing some sort of court case that's make or break, and there are several out there right now that are really make or break. A company called Windstream Communications, really a value trap because right now it's the yields look pretty good on those bonds if you take a look at them, but they're involved in a court case with a company called Aurelius, and it's a potential bankruptcy case. If they lose the case, they're going to file almost certainly going to file Chapter 11 bankruptcy. So that's the example of a single event that can really undermine prices. There's another company called Unity that Windstream contributes more than 2/3 of its cash flow. So if Windstream does declare Chapter 11 and has to renegotiate its contract or stops paying on its contract, whatever happens there, it's going to hit Unity very hard. Those bonds that you see for that company, not as attractive as they look because, again, a single event can undermine the prices. Finally, overexposure to the cycle. And again, this is an example of learning something the hard way. Looking at some of those energy bonds in the at the bottom of the last cycle. Of course, like I said, with the Lynn bonds, we've kind of come back from that, not entirely, but being willing to hold on and just hold on and hold on has worked out. But again, we would have been better off just not being in there. So you find a bond that's very, very attractive, but yet is in a business that's that would be extremely compressed if the economy should happen to sputter out here. Not the kind of bond that you want to own. So we want values. We don't want value traps. I'm going to talk a little bit about some of the distinctions between the two. Again, I mentioned Frontier Communications bonds as being a value trap. This is a graph of these bonds, the price of these bonds. And about the time when we came out with our last deep dive investing, where we talked about these, was about the time where you see that last little decline in these bonds. Since then, they've kind of ratcheted along the bottom there. It doesn't look like a great chart to me, but certainly it was a good day on the day that I made this graph, which was the 14th of September, and there was some buying of these bonds. I think that's a lot of index buying. These bonds are issued by Frontier Corporation. And if we go back to that previous slide, and I will for just a second here, on the value trap side, dawning debt distribution, definitely. Single event can undermine prices. Kind of, but that would be more or less just the earnings that are going to be coming out here. This company is shedding revenue, so underlying business has not bottomed. Is it overexposed to the cycle? Telecommunications is a pretty steady business. This is more of a secular decline here with Frontier. So again, going back to the graph of Frontier Corporation, definitely a value trap. And that yield of 16%, that's a yield of maturity. So if Frontier remains solvent between now and doesn't restructure its debt between now and September of 2025, that's your annual return on these bonds. Looks pretty attractive. And if I had an ounce of confidence that Frontier was going to make it over that time, it could be an interesting play. I just don't have that kind of confidence, and again, it looks to me like a value trap. This is the yield, so it's sort of I mentioned that, and those of you who invest in bonds know this, of course, full well. Prices and yields are inversely related, so this you kind of flip over the previous graph, and you can see the yield to maturity. Again, the coupon yield on a bond doesn't change. It's still going to pay the same amount on that par value. The company's, in this case, is still going to pay $110 for each year on $1,000 par value. That's a pretty steep price, but that's not going to change in any case. But what does change is the price of bonds, and this when you see a yield to maturity that high. Investors are really making a bet that there's a better, pretty good odds, or at least a pretty high risk that it's not going to be able to make that payment throughout. You compare that to less than 3% for 10-year Treasury note yields. That's 13 percentage points difference. That's a huge risk premium. Again, pretty good warning to you, the investor, that something is amiss. And again, like I've pointed out, these bonds have all the signs of being a true value trap. Debt distribution, I mentioned, is a kind of a tip-off that things are there's a high degree of risk here. This is again, shows you these basic lines show you how much debt comes due every year for Frontier. Down at the bottom is kind of a summary look where you can see. They have about $17.5 billion of debt coming due, which is multiples greater than their stock market capitalization. They don't actually pay a dividend anymore. They have eliminated that. But you can see a lot of that debt, more important than how much it is how much of it is coming due in a very limited period of time. And the weighted fixed coupon rate, about 9%. But as I showed you in that other slide, the yield to maturity on bonds that really aren't that far off in the future is over 16%. So what that tells you is that whatever they have to refinance there, odds are they're going to have to pay more than what they've been paying. And that comes right out of their cash flow, and it threatens the solvency, the cash cushion, and the solvency of the overall company. Weighted maturity here of this debt, about 6 years. That's a lot of debt coming due in a short period of time. So again, another reason why these Frontier bonds I consider to be a value trap. Attention are bonds issued by a company called NRG Yield, which is about to become Clearway Energy. This is part of a deal that some of you are aware of if you read what I've written in Conrad's Utility Investor, for example. This is the NRG Yield is a yieldco. It was launched and sponsored for roughly 5 years, I guess, by a company called NRG Energy. NRG Energy, though, had been an underperformer for a long time, and some activist investors came in and forced up a restructuring. So they were forced to sell their NRG Yield unit, which was really the strongest piece they had. And the buyer, though, is a company called Global Infrastructure Partners. It's a privately held entity, very deep-pocketed, a lot of inventory in terms of contracted wind and solar projects that they can drop down to NRG Yield, the yieldco. which again will be called Clearway Energy Incorporated. Some of the details of this deal, I think, are quite positive. There are no incentive distribution rights involved for GIP. Their interests are very much aligned with those of Clearway Incorporated holders. So this is a really good stock, I believe, to buy. I also like the bonds as maybe a little more secure way to pick up a really nice yield to maturity. And as you can see, they trade right now pretty close to par value, and at that price, they're yielding a little over 5% to maturity. That's a roughly 6-year maturity for these bonds. Pretty nice yield for that yield to maturity for that, and most of that is going to be current. Pretty much current income is actually going to be a little bit higher than the coupon yield. Very solid little entity there, and as a yieldco, and we have done some pretty extensive reporting in deep dive investing. So if you're really interested in yieldcos, as well as this, including this yieldco, go back and look at those. Look at my report on the yieldcos. I've actually updated them a couple of times, for some more background info. But bottom line, the model here is that global infrastructure partners will develop big renewable energy projects, and they're through an entity which is actually called Clearway Energy Group, and then they're going to be dropping down these assets in very advantageous sales to Clearway Energy Incorporated, which is the former NRG Yield. Not sure if these are going to be called Clearway bonds or if they're going to continue to keep the NRG Yield name. Doesn't matter. They're still the same company. But I think a great opportunity to buy these at this point. As I did with the IEnova bonds, I'm presenting here a kind of a fact box here. So with some information on how to buy them, where to buy them, how much is out there, and so on. So you can see where, again, peruse this at your leisure, the ins and outs of these particular bonds. Kind of an interesting piece of this is that the minimum increment is going to be 2,000. So that's again something to keep in mind. And that's basically more or less. Again, like the IEnova bonds, you might have to be patient to buy these. They may not be available right away, but I think if you're able to buy them, kind of a one-stop shot, one decision type of investment. Next slide here, the debt distribution. You can see it's a little bit more skewed to the near term than particularly IEnova, but it's a little bit more maturing sooner than I'd like to see. Were this company still a piece of NRG Energy, I would be considerably less excited about it at this time. And in fact, this was not a name that we had in our long-term yieldco portfolios for that reason. But now, as part of Global Infrastructure Partners family, there's just a lot deeper pockets there. There's a lot more security, and you have a very strong company that's dedicated to making this thing grow. So that really makes that really does increase my comfort factor with the stock as well as the bond, as well as these bonds. So again, a strong company. If your broker comes at you with another NRG Yield or Clearway bond that's not this specific one, the thing I would just watch would be the years to maturity. I think you do want to keep even the high yield bonds you buy. I think you want to keep them into the nearer term maturities. I don't think you want anything maturing in more than 10 years, even if it's a deeply discounted high yield bond. Just too much interest rate risk. Our interest rates right now, corporate bond rates, they're still at the lowest levels in generations, and there's not, when you get to this point, there's not a lot of room for them to drop. There is a lot of room for them to rise. So the way you protect yourself, again, keep those maturities short, and again, that's how you also maximize the value of when these things, you know, get stronger. The longer term debt you see out there, that can benefit too if interest rates stay fairly level. In fact, it could actually benefit more, but you are taking on that additional risk, additional interest rate risk. So again, a different factor there, something to be careful.
No risk or obligation. That's more than 2 months, more than 60 days, absolutely risk-free. If you decide at any time between now and November 20th that deep dive investing isn't for you, for any reason whatsoever, simply give us a call or drop us an email and we'll refund 100% of your subscription price. Absolutely zero ridiculous processing fees or restocking fees like some publishers out there charge. I guarantee it. And for the first time ever, for any service or newsletter we publish, we've decided to offer new trial memberships on a prorated basis. Simply put, should you decide at any time following your risk-free trial period that deep dive investing no longer meets your investment goals, we'll refund the unused portion of your subscription with no questions asked and no hard feelings. Simply click the Start Your Risk-Free Trial button below this video and let me know you'd like to take a trial subscription to deep dive investing today. I'll rush you a username and password for our secure website, granting you immediate access to all the detailed presentations and strategy sessions I've outlined in this report, plus concise executive summaries for all our themes and recommendations to help you get started profiting immediately. To my knowledge, there's no financial advisory service on the market today quite like deep dive investing. We don't just scratch the surface of the themes, industries, and stocks we cover. In each issue, we want to give you a thorough understanding of the fundamentals that drive our big idea investment themes, so you will have the conviction to benefit from our best of the best ideas and recommendations. Roger and I attend industry conferences, participate in management conference calls, scrutinize financials, and leverage our contacts across the industry to track down the data, charts, and key fundamentals you need to make an informed, high conviction buy or sell decision. And all our deep dive research is delivered to you in a novel and easily digestible format. Issues are delivered at least 20 times each year in the form of a detailed video presentation that includes a slide deck in convenient PDF format, packed with all the charts, financial data, valuation metrics, and background research you need to gain conviction and an understanding of our top ideas. And just to get you up to speed so you can act quickly on our recommendations, we publish a Just the Facts Please executive summary of our main conclusions and recommendations with each new issue. Roger and I have been discussing a service like this on and off for years, and we just launched Deep Dive Investing about 18 months ago to a very small group of beta testers. It's quickly become a hit with their readers, and we've decided to expand the service even further. Our new active total return portfolio is for investors looking to earn a positive return in any market environment through a combination of dividends and capital gains. It includes specific recommended allocations to a portfolio of stock recommendations, plus market hedges aimed at protecting your downside during market sell-offs and corrections. In short, we believe the total return portfolio will help you take advantage of the melt-up rally in the market today and protect your downside during the next bear market. For a strictly limited time, we're offering the service to new risk-free trial members at a discounted price of just $1,500 a year. And as I mentioned earlier in this letter, through midnight Eastern Time this Tuesday, September 18th, we're offering a small allocation of 30 annual prorated trial memberships. Plus, to make the decision to try deep dive investing as much of a no-brainer as possible, I've decided to include one additional exclusive bonus. Start your risk-free trial to deep dive investing today by clicking the button below this presentation. And I'll throw in a 1/4 subscription to our Energy and Income Advisor service. That's a $299 value, absolutely free of charge. Energy and Income Advisor covers all things energy, from high-yield MLPs to shale exploration and production companies and energy services firms. Energy is historically one of the best performing sectors in the final stages of a bull market, and oil prices are on the move right now. In short, we believe now is the time to start assembling a portfolio of energy stocks while the sector is still undervalued. I sincerely hope you'll join us today. I've given you my very best price offer and a risk nothing and keep everything guarantee. That means you have zero risk joining us. To get started, simply click the Start Your Risk-Free Trial button on this page, or give our customer service manager, Sherry, a call toll-free on 1-877-302-0749. That's 1-877-302-0749. Between 9 a.m. and 5 p.m. Eastern Time, Monday to Friday. Thanks for listening, and I look forward to welcoming you to Deep Dive Investing in the next few minutes. Here's to your wealth. To get started, simply click the Start Your Risk-Free Trial button on this page.